Hello everyone, I hope you all fine and doing great. And myself Raja Kumar, I take class for CMA in the Group 2 paper number 10, Cost and Management Accounting and Financial Management. Okay, today we start with the study note 10, capital budgeting. That means investment decision. Okay, in this class, we see that three formulas, and in this video contains three formulas and sums we do, that formula explanation and the sums we do. Before we go into this study note 10, I told something in the capital budgeting. This capital budgeting means nothing but if you think accordingly for if you are example, if you are financial manager, or if you think you are a CEO of a company and a CFO of a company, for them you think accordingly. You must do the capital budgeting for them, or you are in the position of a CEO, CFO. You must be make that capital budgeting. What is a capital budgeting? It is a budget for what are the things you invested that give your returns, or it gives losses. Like that, you budget the capital, how many years it come back, and how many percentage it will be get the return, and what are the current value of that capital, current value and future value for that investment. Everything we study in the capital budgeting. In the capital budgeting, in the inter book, they give the elaborated and the difficult sum in the book only, study material. We start with the simple sums and understand the basic concept. After that, this basic concept also asking in the examination. After that, compressive sum we go further, and we discuss that compressive sums in the previous year question paper and workbook also. Just go through that only. Study note sums are difficult, that is asking in only final groups only, not for intermediate level. Okay, this is the go. Just approach this way. Start with the capital budgeting in this way only. Don't start with the capital budgeting and study notes sums. You go to the previous year sums, and after start with the workbook, and then you come to that study material sums. It will be benefited for you. This is the how to start the study note routine is this way you start. Then second thing, I tell that I give some notes for capital budgeting investment. Just note it down and start the class. Okay, we start the class. Before we start the class, I share the screen. Yes, this is that capital budgeting investment decision. Capital budgeting investment decision. Capital budgeting investment decision, meaning we see that capital budgeting, we see that both the same. Capital budgeting represent the value for appropriation and expenditure for fixed assets during the budgeted period. Capital budgeting represent the plan for the appropriation and expenditure for fixed asset during the budgeted period. Okay, this means if you have a capital budgeting means if you have investment in something, you want to appropriate it and expenditure fixed asset for the fixed asset during the particular represent the plan. This is the plan. Okay, this is the plan for the your investment, appropriate investment, and or a fixed asset, or mostly investment means what we put the investment in the fixed asset only, and fixed asset also machinery and plant, everything it comes under the fixed asset. That fixed asset, that investments all put into that budget is known as capital budgeting. We put for that budget, not for the sales and sales budget, like same as a sales budget, purchase budget, and we create that cash budget, like that working capital management, like that we put that separate budget is known as capital budgeting for a fixed asset and investment. Okay, this is the simple meaning. You create a budget for a fixed asset investment using that capital budget. It has some techniques. It contains 7 techniques in the capital budgeting. Today we see the 3 techniques. Okay, today we see the 3 techniques. First technique, payback period. Second, accounting rate of return. Third, discounted payback period. Okay, in the payback period and accounting rate of return is a traditional method, and the new method is a discounting payback period. We start with the three techniques and concluded these classes. After that, balance techniques and comparative sums following classes we will see. Okay. Okay, we start with that investment decision, capital budgeting technique, payback period. What is payback period? Payback period, if you invest something, I write it, it will be benefited for you. Okay. Payback period. Okay. Payback period is nothing but we find out how many years our investment, this is investment, pay back to us. Payback period is what? Payback period means how many year our investment pay back to us. We find out that payback period. Then second, accounting rate of return, in short we tell that ARR. ARR equal to, that means ARR means how much percentage of profit in the particular period. Okay, then discounted rate of return we see in this class in the last. First we see the both the traditional method, payback period, and the accounting rate of return. Okay, in this sum, just start with this sum. Okay, in this sum, payback period, there is a 2 method in the asking in the examination. First, equal cash flow they given, unequal cash flow they given. This is the 2 method they asking the examination. Payback period they asking simple question like that. They asking means there is a 2 method, equal cash flow method and unequal cash flow method type. They asking that we see that the equal method is so easy. That is, you can able to understand the unequal method. You can easily crack that equal cash flow method answer. This is the unequal cash flow method sum, because cash flow is not same for the various cash flow is not same for the year 5 years they given. project A has an initial investment. Project A has an initial investment of rupees 10 lakh. It cash flow for 5 years for 3 lakh, 3 lakh 60,000, 3 lakh, 3 lakh and 2 lakh 64,000 and 2 lakh 40,000. Like that they given. We find out the determine the payback period for this. Okay. In the payback period they asking. In the payback period they asking. We do the sum. Following step we can do. In the process only you follow that. In the payback period, first of all, I tell that formula for the payback period. Payback period equal to okay, formula is the most important. That's why I'm typing that ready for that. Payback period is equal to total initial capital investment divided by net annual cash inflow. Okay, this is the formula for payback period. Payback period formula what? Total initial capital investment divided by net annual cash inflow is known as cash flow. It's also known as cash flow after tax. In short, detailing net annual cash inflow is known as payback period. Okay, how we do? You see that the question they given. First we do. Sorry. First we do in the question they given 3 lakh, 3 lakh, 5 years, 3 lakh, 3 lakh 60,000. 10 lakh is the initial investment. Initial investment is 10 lakh. They given. We find out the payback period. They asking how many years I get back the 10 lakhs. They asking. Okay, this is 10 lakh. How many years we get back the 10 lakhs? Okay, they asking. What are the cash flow they given? 3 lakh, 3 lakh 60,000 and again 3 lakh first year cash flow after taxes 3 lakh second year 3 lakh 60,000 third year 3 lakh and fourth year 2,64,000, 2,64,000 they given. Okay, we find out the cash flows from there. This is the second step. First step, what is the initial investment? 10 lakh. They asking that pay how many years I get back the 10 lakh. We do that first year. We do that as a simple cumulative payback. Cumulative cash flow after tax. This is for how many years we reach the 10 lakh near the amount. First year we get 3 lakh. Second year we add with the 3 lakh plus 3,60,000. Add with the 3,60,000, we get 6,60,000. Cumulative means this only. First year add with the 3 lakh. First year 3 lakh is there. You put it same. Second year 3 lakh. Add with the second year cash flow after tax. We get 6,60,000. And again we add with the 3 lakh. We get cumulative cash flow after taxes 9,60,000. And we almost reach that 10 lakh, near the 10 lakh in the year third year. In the year third year. In which year? Third year. Third year we almost reached the 9,60,000. The balance of 10 lakh and 9,60,000 is 40,000. That 40,000 we calculated that fourth year. In the fourth year 40,000 is we want. In the 12 months we have invested 2 lakh. We have the cash flow of 12 months is 2,64,000. We divided it with 40,000 and multiple with the 12 months. We get the how many month we get back that exact 10 lakh. How many month? Calculated at it around something 1.8 like that. It come. 2 months is there. You just answer it. You just give simple answer as the payback period. The payback period is equal to 3 years and 2 months. You simply write as 3 years. Sorry. Two months. This is the answer. Just note it down. This is the simple sum. The most examination they asking the any 3 mark, 2 mark question like this only. There is nothing is there. What is the given project has been initiated. Initial investment is 10 lakh. The cash flow of the 5 years. This is unequal cash flow. The equal cash flow means they given as a 3 lakh, 3 lakh, 3 lakh, 3 lakh, 3 lakh. They given. We add this all 3 lakh. All 3 lakh. First year 3 lakh is there. Second year 3 lakh is there. Third year 3 lakh is there. 9 lakh is there. 9 lakh plus 3 lakh not match it. It extra of 10 lakh going like 12 lakh is going. So we calculated break with the 3 lakh. The third year we break, and we calculated that balance of 1 lakh divided by 3 lakh into 12 months. We get that answer for that how many months we get that payback period in equal method of payback period question. In the unequal method of payback period question, you just add with the number of years. First year add with the second year, and second year add with the third year add with the fourth year. If almost reach with that initial investment of 10 lakh, we stop with there and we find out the exact month. The 3 year 2 months I get pay back my 10 lakh entire 10 lakh amount. This only asking in the payback period question. Okay, this is the simple question. We find out the payback period for that. We go to the next concept. I hope you understand this concept. We go to the next concept. Okay, we come to the next concept is accounting rate of return. What is accounting rate of return? Beforely I said that how much percentage of profit, how much percentage of profit we get in the particular period. We find out that in the accounting rate of return. Okay, in the accounting rate of return there is a, I give that unequal sorry, we start with the equal method. Here also there is a two-way they asking equal PAT given and asking that answer for that, and unequal PAT given, and we find out that answer for accounting rate of return. What is the formula for accounting rate of return? Accounting rate of return formula was average annual net income. This is the PAT, profit after tax. We see in the profit after tax in the statement of income. We see that sales minus variable cost minus contribution. It will come contribution minus fixed cost. It will come profit, and the profit we minus that interest. That profit is a EBT. EBT minus interest is a EAT. Sorry, EBT minus interest is a EBIT minus interest is a EBT. EBT minus tax is known as EAT or a PAT. That profit after tax is, this is only average rate of return of income. That profit after tax, that profit only we taken, that average we taken, and we find out that divided by average or a initial investment into 100. Okay, in this sum they given computation of average rate of return. ARR is the cost of asset is 2 lakh. The cost of asset is 2 lakh. Used life is 5 years. Cash flow after tax they given 86,000. In the sum PAT is given? No, PAT is not given. In the situation what we do? Okay, we see that Okay, we see the sum. Sorry for the late. Okay, we see that average rate of return. How we find out? They given, what is they given? 2 lakh is the fixed asset. Sorry, I write in wrong way. Fixed asset equal to 2 lakh. They given useful life of the asset is 5 years. They not given the PAT. Here they given any mention in the PAT. They only given cash flow after tax only they given is 86,000. It include that depreciation also. I exclude the depreciation, we get PAT. I give the formula for that. PAT equal to, sorry, cash flow after tax equal to PAT plus depreciation. Okay, we exclude the depreciation, we find out the PAT. We know cash flow after tax is 86,000 and we don't know PAT and we know that depreciation. How we know? Depreciation is difference of fixed asset and useful life equal to fixed asset is 2 lakh, useful life of the asset is 5 years is equal to 40,000 is the depreciation. We find out the PAT equal to PAT equal to 86,000 minus 40,000 equal to 46,000. We find out the PAT in the equal method. We find out the PAT in the equal method. What the next? Initial investment they given and into multiple by 100. We simply do that sum. Initial investment what? 2 lakh they given. ARR equal to 46,000. We find out the PAT divided by 2 lakh into 100. We find out the 23% of ARR is at 23%. This is the answer. Simple, we complete it in the equal method. This is the concept. We do this the step. They not given the PAT directly. We find out with the cash flow after tax. Cash flow after tax include the depreciation. We exclude the depreciation. We get that PAT. After getting the PAT, we divided with the initial investment, which means the fixed asset cost. The cost of fixed asset, initial investment is the cost of fixed asset divided by with and multiple with 100. We get that percentage of ARR. Okay, we do that second sum. In the second sum, what they given? Unequal method. Project Q requires an investment of 10 lakh. Project Q requires the investment of 10 lakh and the yield of the profit after tax PAT and the depreciation as follows: year 1, 2, 3, 4, 5 PATD. PATD they given 50,000, 75,000, 1,25,000 and 1,30,000 and 80,000. At the end of the 5 years, the plant was sold at the 80,000 rupees. You are required to calculate that ARR. Okay, they give the sum. Project Q requires an initial investment of 10 lakh. We find out the ARR percentage. In the project Q, an investment is 10 lakh. They given a PATD. PATD means we all add with that and divided by number of year of used, and we get that average annual income of that PAT, and we again divided with the initial investment, multiple with the 100, we get that sum answer. Okay. They given as a sale of investment. They given in the ARR sum. They give the sum twist is there. The ARR, no sale of investment we not consider, so we ignore it. We go to the sum. Solution. First, we add all the, find that average annual net income. This is PAT. Average PAT we find out. They give average PAT. They give PAT. We just simply add with that, divided by number of years, we get that average PAT. We know that opening plus closing divided by 2 is average. Okay, like that same concept we apply here. We know that average stock formula equal to opening plus closing stock divided by 2 is equal to average closing average stock. Here we can find out the same concept. We follow that average annual net income of PAT. Here they given PAT 50,000 plus 75,000 plus 1,25,000 plus 1,30,000 plus and 80,000 divided by 5. It will come, I calculated already, 92,000. You just check it out, and in the 92,000 we find out, we divided by 92,000 divided by the ARR formula we put here. 92,000 divided by initial investment is a 10 lakh into 100, we get 92%. We complete the sum of ARR unequal method. In the unequal method, this is the simple answer. We calculated it. That's it. There is a no big deal with that payback period and in ARR sum. There is a simple concept. The payback period, we find out the number of year of how much year we get back that our investment. We find out in the payback period how much percentage of profit or how much percentage we get return in the we get return is no, we calculated in the particular year or particular period is we calculated known as average rate of return, accounting rate of return. Okay, I hope you all understand this 4 method. In the payback period, there is equal and unequal method, and the average rate of return also have both equal and unequal method. I hope you all understand this concept, and see in the next class. In the short video, I put the next class discounted rate of return. We see that that also in the short I put. Thank you for watching, and if you have any doubt, contact me at the Telegram. Thank you, Pradeep sir.